The cash flow statement is one of the three financial statements of a business. Understanding the cash flow statement is key to analyzing stocks and identifying excellent investments. The cash flow statement is just like the list of transactions you make in your bank account, except for a business. The cash flow statement links both the income statement and the balance sheet. Like the income statement, the cash flow statement shows what happened over a year or quarter. It isn't just a snapshot in time like the balance sheet. The purpose of the cash flow statement is to show shareholders the cash that was used or generated in operating activities, investing activities, or financing activities. To understand the cash flow statement, we'll use Tesla's cash flow statement from their 2019 annual report as an example. Here is Tesla's cash flow statement from their 2019 annual report. As you can see, the cash flow statement has three major sections: cash flow from operating activities, investing activities, and financing activities. Cash flow from operating activities is the amount of cash the business produces in a year from operating the business. This is the amount of cash profit that Tesla earned selling products before including any non-cash charges. Cash flow from investing activities is the amount of cash Tesla received or spent on property, plant, or equipment and other investments in their business. If Tesla were to spend money to build a new factory, it would be included in this section. Cash flow from financing activities is the amount of cash Tesla received by issuing debt or stock. It also includes the amount of cash Tesla spent by paying down debt and buying back stock. If Tesla issued corporate bonds and sold them, the money they get would be listed here. If Tesla pays down bonds or other debt, it would also be included in this section. Now we'll go through the cash flow statement from top to bottom. Tesla's cash flow statement shows how they used their cash throughout the year for the years 2019, 2018, and 2017. All of these numbers are in millions of dollars, so the number 1,000 represents $1 billion. The first section is called Cash Flows from Operating Activities. This section starts with the net income, or in Tesla's case, net loss from the income statement. This is Tesla's recorded loss from doing business in the year. After the net loss, non-cash charges are added. Non-cash charges are the recorded costs on the income statement that didn't actually cost Tesla cash that year. One non-cash charge is depreciation. Depreciation is an accounting practice that charges the business for a big purchase over its useful life, instead of all at once. Say Tesla were to buy a big robot for $10 million to help them assemble cars in a factory. The robot would hopefully be used for much longer than just a year, probably at least 5 years. So, instead of treating the robot like a one-time expense, you would depreciate the expense as $2 million a year on the income statement, or $10 million divided by 5 years. This is what is being added back to the operating loss to get the operating cash flow. Tesla didn't actually pay the $2 billion it says they did on the income statement in the year 2019. Remember, the purpose of the cash flow statement is to show exactly how much cash the business generated and where the cash went in the year. Amortization is the same thing as depreciation, except it's with assets like patents or copyrights Tesla bought. These types of assets are known as intangible assets. So, depreciation is for tangible assets and amortization is for intangible assets. The next several line items are also considered non-cash charges. They are added to Tesla's net loss since Tesla didn't actually spend any cash that year on these items. The next part of the operating cash flow section is called changes in working capital, or as Tesla calls it, changes in operating assets and liabilities. Working capital is the current assets subtracted by the current liabilities on the balance sheet. The changes in the current assets and current liabilities from year to year affect working capital and are included so you can get the correct operating cash flow. Accounts receivable is just the amount of money Tesla expects to receive from customers or suppliers. In the cash flow statement, it doesn't represent actual cash. However, accounts receivable is recorded as revenue on the income statement. So to find the correct operating cash amount, the change in accounts receivable from the year before has to be added or subtracted from the operating cash flow calculated so far. The same thing happens if inventory increases from the year before. Tesla would subtract the inventory dollar amount from the operating cash flow because the increase in inventory means that more cash was spent. The rest of the current assets and current liabilities are just the dollar amount changes from the year before. Finally, after adding and subtracting everything from the net loss, you get Tesla's operating cash flow of $2.4 billion for the year 2019. This is basically the amount of profit Tesla made in 2019 before considering any non-cash charges. The next section is called cash flow from investing activities. The operating activities show how much cash Tesla produced as a business, and the investing activities show how Tesla decided to invest some of this money. You can see that Tesla invested $1.3 billion in property, plant, and equipment in 2019. This part can also be called capital expenditures. Capital expenditures could demonstrate the money Tesla spent on repairing or replacing old machines and computers, or it could represent the money Tesla spent on building new factories and buying new machines to grow. Capital expenditures of a business are tricky for investors. Most businesses don't exactly say how much cash was used to maintain existing property, plant, and equipment, and how much cash was used to grow the business by buying even more property, plant, or equipment. The rest of the items are also investments Tesla bought to maintain or grow its business. The solar energy systems are the solar panels used to operate its facilities, and the intangible assets are copyrights or patents Tesla bought. Tesla receives grants from the government for making electric cars and clean energy systems, so this number is added back to the cash amount invested. The investments in business combinations are the amount of cash Tesla invested in Tesla's part of an investment with another business. For example, Tesla and Panasonic invest in some factories and equipment together, so $45 million could be part of Tesla's contribution in 2019. The total amount of cash Tesla used for investing activities in 2019 was $1.4 billion. This number is negative, so this means Tesla spent $1.4 billion on investing activities. Some companies may have a positive amount in this section. This means that instead of buying more property, plant, or equipment, they sold off existing property, plant, or equipment. Generally, it isn't a good thing to see a company selling off parts of the business, because that means they're downsizing instead of growing. But then again, every business is different, and it could benefit shareholders if some assets are sold off in a failing part of the company. The last section of the cash flow statement is called cash flow from financing activities. The operating cash flow shows how much cash Tesla made or lost from operating their business, and the investing cash flow shows how much cash Tesla spent or received from buying more assets or selling existing assets. The financing section shows how much cash was received from issuing new stock or taking on more debt. It will also show how much cash Tesla spent on buying back stock from the stock market or paying down existing debt. Proceeds from the issuances of common stock shows how much cash Tesla received by issuing more shares on the stock market. One way businesses can choose to raise more cash is to issue more shares out of thin air. For instance, if Tesla had 1 million shares outstanding and the company chose to sell 20,000 more shares, then the shares outstanding would become 1,020,000. This isn't really a good thing for the stockholders, since it makes their ownership in the business worth less than before. This effect is called stock dilution. However, many young companies issue shares instead of raising debt because it's often harder for them to get debt, and a young business usually requires a lot more cash to operate than the business provides. In more mature companies, instead of issuing shares, the business may do share buybacks. Share buybacks are when the business buys back its stock on the stock market and increases the ownership per share in the business. This helps the shareholders of the business because they will own more of the earnings even if they don't purchase more shares. The next part shows how much cash Tesla received from issuing debt like bonds or loans. Repayment shows how much cash Tesla spent on repaying the debt they issued in the past. The rest of the items in this section are other finance-related activities showing cash received and spent. If Tesla were to pay a dividend, it would be shown in the cash flows from financing activities section, and if Tesla owned part of another business, it would show up in this section too. Tesla happens to own part of another business, and you can see they received $279 million from non-controlling interests in subsidiaries in 2019. After adding and subtracting all the cash used and received from financing activities, you'll see that the total cash Tesla received was $1.5 billion in 2019. At the end of the cash flow statement, you'll see the total amount of cash, cash equivalents, and restricted cash Tesla had at the end of 2019. In 2019, Tesla had $6.7 billion in cash, cash equivalents, and restricted cash available for use. This is the end of the cash flow statement. The sections below represent supplemental information to the numbers already given in the cash flow statement above. There's a lot to look for when analyzing a business's cash flow statement, but typically it is best to see a positive cash flow from operations, a negative cash flow from investing activities, and a negative cash flow from financing activities in mature businesses. Young and growing companies typically don't have an investor-friendly and quote-unquote pretty cash flow statement that a company like Apple or Coca-Cola might have. There are a lot of important things to consider when analyzing a cash flow statement for a potential investment. But now, you can read a cash flow statement and see the basic financial position of a business. I recommend much more research in analyzing financial statements before considering a serious investment in a business. I hope this was helpful. Please leave a like and subscribe if you want more content like this. Leave any comments or questions you have down below, and I'll see you again next time.